You know I'm a big believer in the North American oil and gas renaissance. This is one of those long-term themes that can make you big money year after year, but only if you know how to play it. And for those of you who don't want to gamble on where the price of oil or gas is headed, there are always the pipeline plays. Think about it. We've found so much new oil in this North American continent of ours that we have a tremendous shortage of pipeline capacity. We know that oil is being shipped by rail, by barge, and even by truck. That means the pipeline operators with the capital to build out new pipe have a terrific long-term growth opportunity. Which brings me to Enbridge, ENB, the company that operates the world's longest crude oil and nat gas liquids pipeline system running through Canada and the United States. Enbridge has exposure to the red-hot shales we talk about all the time here, as well as to the Alberta oil sands. And they've also gotten in on the natural gas gathering business, where they collect gas from the wells and transport it to a central location to be processed. Plus, Enbridge has an alternative energy kicker, 1,300 megawatts of wind, solar, and geothermal energy. It's not an afterthought. But the big story here is the pipelines. And the fact that over the next 2 years, Enbridge has $18 billion worth of growth and expansion projects. Right now, the company pays you a solid dividend, yields 2.8%. That's because the stock's going up so much that it's that small. And these new projects will fuel the growth that will allow Enbridge to keep raising its dividend for years to come. Now, the stock has given you a nice 13% return since we last spoke to the CEO 6 months ago. I think he could have more to run. Let's check in with Al Monaco, the president and CEO of Enbridge, hear more about where his company's headed. Mr. Monaco, welcome back to Mad Money.
Hi, Jim. Thanks for having us back.
Well, Al, I got to tell you, you probably have twice as many projects up your sleeve as any other company I deal with in your industry. Do you have the financing and do you have the wherewithal to get these projects done?
Well, it's a very good thing to point out right off the bat, Jim. The fact of the matter is you have to be very disciplined around financing with that level of capital investment in front of you. And in our case, that means having strong credit ratings, having good liquidity in the event that market disruptions occur, which we obviously have to plan for but don't expect, and making sure that we develop our markets. So whether that's the debt market or the equity market, making sure that's always available to us. So we have to be disciplined. The other thing is, Jim, you can't get cute about raising capital. You have to raise it when you need it. And in fact, in this environment, it makes sense for us, given the amount we have, to start ahead of the curve and try and get as much done as we can.
How much of that do you think will be equity versus debt?
Well, the large component of it will be debt financed from here on in. We've done a lot of equity in the last year or so. We still have some additional equity to raise over the longer term. We have various sources of equity financing for that, but the primary component will be debt, at least for the next little while.
Okay, what are the returns on anticipated capital for, say, the biggest one that you just talked about, the one from the beginning of March, the $7 billion mainline replacement program?
Well, if you talk about returns on equity, Jim, generally we look at that as in the lower double-digit returns. And that can vary. Sometimes it starts a little bit lower than that and ramps up. But generally, we look at lower double-digit returns. And that's reflective of the business model. As you know, we're not a producer or refiner, so our returns tend to be a little bit lower. However, they are more predictable. And, of course, with the capital we have in front of us, are growing nicely.
And the reason I ask that, obviously, is because you've got 18 billion projects, but you've got this terrific return on invested capital formula, which I think leads me to be able to ask a logical question, which is that we can expect, therefore, dividend boosts over time.
Well, that's a great point, Jim, and that's exactly what we provide for our investors. The earnings per share growth that we're looking at on average over the next 4 years is somewhere in the 10 to 12% range annually. Given we're currently within the 60 to 70% dividend payout, we think we can keep dividend growth at about the same pace as earnings per share growth. Now, if you look to the future, though, with all these projects we have coming into service, there is also the potential to further accelerate dividend growth.
Wow, that's terrific. I see the capital, I believe, behind you. Now, there's a subtext throughout the March 4th conference call out. It's really pretty interesting. Several times analysts are asking, for your new pipelines, do you need the presidential permit? Throughout this, you insist that you don't. It made me feel like that one day, perhaps, we won't need Keystone in this country because of what Enbridge is doing all around our country.
Well, Jim, what we've always said about that, to go to the last part of your question there first around XL, if you look at the supply profile out of the Western Canadian Basin, it's very clear that we need all of the pipelines being proposed. As far as the Line 3 question you had there relating to the presidential permit, Line 3 already exists under presidential permit. Therefore, we don't need a new presidential permit to replace it. That's the issue.
All right, Al, do you think that we have the possibility, if our country does not play ball, frankly, I have to ask you with your country, I know you can't speak for your country, but that we're going to have to ship a lot of that Canadian oil to China because there are certain interests that are blocking it being sent here?
I think it's a real issue, Jim. I mean, if you're a Canadian producer or a Canadian government, province or federally, the last thing you want is an inability to get your crude to market. And for many, many years, the United States has been our primary market. I think it'll continue to be our primary market. But with the growth in supply, it only makes sense to diversify your markets if you're taking care of business. So I think ultimately you see producers and pipelines wanting to get to coastal markets and ultimately export markets.
All right, there's been a lot of dispute lately about how many jobs are really happen if you do a pipeline. I know when I asked the Secretary of Labor, listen, you could probably employ more people than anybody. When you do $18 billion worth of pipelines, what kind of jobs and what kind of multiplier do you get?
Well, it's a tough question because there's so many variations on that. And I know it's been in dispute. I'll give you one tidbit maybe that might help, Jim. So for our Line 3 expansion, we're looking at direct and indirect jobs of about 40,000. But to me, I think that misses a little bit of the point here. If you look at the projects we have in construction, somewhere in the order of $41 billion, including secured and unsecured, that's going to generate a tremendous amount of spin-offs. I'm talking about having to buy pumps, valves, the pipeline itself, and all the contracting and labor that goes with it. So I think the focus on jobs is just one element of it. There's a tremendous amount of spin-off that goes with it that's good for the economy, and I think that's good for both Canada and the United States.
Well, Al Monaco, you have delivered better than almost every single pipeline company I deal with, and of course that's because you keep having such great expansion plans, which is what you need if you're going to be able to put through dividend increases. Thank you so much, Al Monaco, President and CEO of Enbridge.
Thanks, Jim.
Guys, the secret to these pipelines and why I have not talked about most of them lately is they don't have growth. If they don't have growth, they can't put through dividend boosts. If they do, they can, which is why I like Enbridge better than just about every other pipeline company out there. Stay with Cramer.